Great. Well, welcome back to our next lesson, which is thinking about building the cash flow statement. And you can see the three sections to the cash flow that we want to look at: the operating cash flows, the investing cash flows, and the financing cash flows. And the sum of those three subtotals will get us down to net cash flow, net cash inflow or outflow. And we'll add that to our beginning cash to get to an estimate of the ending cash position. So normally we'd start at the top with net income, and we're going to find that from the income statement. So row 19. And the first thing we do is add back depreciation. Depreciation is an expense. It's been recognized in the income statement. We've not shown it separately in this model, but nevertheless, it is part of operating expenses. And it's non-cash. It's an accounting expense. So I need to add that back to my net income to get a measure for my cash net income. So I'm going to find the depreciation from my workings, and I'm putting a minus sign in front of it so I can express it as a positive. Now the next three items are from a balance sheet, and they are all to do with operating activities: my customers, my suppliers, my inventory. So I've got to measure the cash effect of any changes in these balances. And there's a golden rule really with building cash flow statements that if assets go up, then cash goes down, whereas if liabilities goes up, then cash goes up. And this is really to do with the balance sheet equation, because remember, assets equals liabilities plus equity, and cash is an asset. So assets plus cash, if you like, equals liabilities and equity. And therefore, if other assets go up, cash must go down to balance the equation. Whereas if liabilities go up, they're on the other side of the equation, of the equal sign, cash must go up proportionately. But you can obviously think about it conceptually in terms of customers taking longer to pay us. So my accounts receivable, trade receivables are going up in this case, and that's absorbing cash. So the formula I want to build is from the balance sheet. I'm looking at the prior year accounts receivable in column D minus the current year in column E, and that's going to give me a negative value, which is what I'm looking for here, absorbing a bit of cash in supporting the growth in trade receivables. Similarly with inventories, that has also grown. That's also going to absorb some cash. So the formula is very, very similar, just one row below. And then when it comes to liabilities and trade payables, it's the other way around. So in this case, they have also increased, but nevertheless, that's effectively going to be an inflow of cash for me. I'm taking longer to pay my suppliers, essentially, and that's giving me a cash benefit. So in this case, the formula would be E23 minus D23. And then all I need to do is sum those values down to get to operating cash flow. So build a sum function, I think in this case, equals sum, open brackets, and then just select the 5 rows above there to sum up all those numbers. So nice, healthy, positive operating cash flow. Next one is capital expenditure, my investing cash flow. And I'd always want to show this as negative. It's an outflow of cash being spent on my new property, plant and equipment. So let's go and find the number in the working sheet. And it's 84.8 there, you can see in E12. Press a minus in front of it, and that is my investing cash flow done. And then on to the financing cash flows. So we've got a change in long-term debt, LTD, long-term debt, that stands for, and that's a liability, and it's gone down in this case, isn't it? We've repaid some of the debt. So let's go and build the formula here. I'm going to do current year E minus the prior in D. That's expressing that 25 repayment of long-term debt. Now, there's not been any change in common stock, but nevertheless, for completeness, we should always make sure we account for all the balance sheet line items somewhere in the cash flow. Otherwise, we may well create an error. So I'm still going to build the formula here, and it's the formula similar to what I used for liabilities. For equity, if equity goes up, cash goes up. So I'm going to take E31 minus D31 here as well. So there's not been any change. I'm getting a 0 value, but nevertheless, if there was an increase, it would be shown as a positive. And then the final financing cash flow is my dividends. go and find those from the income statement. Again, express it as a negative number, 22.3. I could have taken it from the workings, but I think it's always best if you can build the cash flow from income statement and balance sheet. And there we have it. We got our operating, investing, and financing cash flows. I'm now going to sum those up into a overall net cash inflow or outflow. And that's 5.4. And now to complete the cash flow, I just need to look at the movement in cash in rows 30 to 32. So starting with my ending cash, which I want to bring in from the balance sheet from the historic period. Let's go and find that number from the balance sheet. It's 15 on D14. Link that into the year one column. Bring down the net cash flow that we've already calculated of 5.4. And then sum those two numbers to get to an ending cash balance. And there we have it, 20.4, which was the number we were looking for. So it looks like we're going to get a balanced balance sheet, which we're going to see in the next lesson.